Welcome back. In this lesson we're going to be talking about adjustments. We're on chapter 4, and I think our chapter material provides an excellent discussion of adjustments, how adjustments work, why they're necessary, and it provides a lot of examples of different types of adjustments that need to be made to the accounting records on a regular basis. I'm just going to go over 2 or 3 more common examples of adjustments. I think it's important that we say up front why we need to make adjustments, why we need to adjust the books on a regular basis, and that is simply to ensure that all of the accounts are stated at their correct balances. And I think after we go through some of these examples, it will become clearer as to why adjustments are required. In the first example at the top, and these 3 examples follow the textbook discussion of adjustments. In the first example, we're going to look at supplies used. Now, when a business first purchases supplies, as long as those supplies are in sufficient quantity where they're going to last for a while, let's say for several months or perhaps longer, the transaction to purchase those supplies would require that we add the amount of supplies purchased to an asset account called supplies. And so let's do that. And let's say the business purchased $2,000 worth of supplies. So we would debit the asset account supplies in the amount of $2,000, knowing that those supplies are going to last us for a while, longer than 1 month. Our credit, by the way, would be either to cash if we paid for those supplies in cash, or to accounts payable if we purchased those supplies on credit. Now, at the end of each month, let's say at the end of the first month, we need to show how much of these supplies, we purchased $2,000 of supplies at the beginning of the month. At the end of that month, we need to show how much of those supplies have been used, and also how much are still on hand, unused. And so the way we would do that at the end of the month, we would do a physical inventory of those supplies. We would actually count them up. And let's say our physical inventory of supplies showed that we had $1,500 of supplies on hand. Well, if we have $1,500 of supplies on hand, that means our supplies account, the asset account supplies, really should reflect that fact. Currently it shows a balance of $2,000, and we need to show that the balance at the end of the month is actually $1,500. Where's the $500 difference? Well, the $500 difference represents supplies that have been used up during that month. How do we show supplies used up for the period of time, the month? Well, we would show that as an expense. And so we would need an expense account called supplies expense. So we need to adjust both of these accounts. We need to show that supplies in the amount of $500 has been used up, and so we need to take that amount out of the supplies account, the asset account supplies, and we also need to show that supplies in the amount of $500 has been used. And so our adjustment to show supplies used would be a debit to supplies expense with a corresponding credit to the supplies account. notice, just as with any transaction, any journal entry representing any transaction, an adjustment or an adjusting journal entry is also a transaction, one that requires a debit and a credit, both of which amounts have to be the same. So our adjusting journal entry must always balance. After we make this adjustment to supplies, our balance in supplies will then reflect the correct amount of supplies on hand, $1,500, and our balance in supplies expense will likewise reflect the correct balance in that account, which is $500. So our adjustment for supplies used in this example for 1 month, 1 month's worth of supplies used would be a debit to supplies expense and a credit to supplies. Our second example is very similar to the first. In this example, we're working with an asset account for insurance, an insurance premium or insurance premiums that have been prepaid. So and that's typically how insurance works. We would, let's say we would prepay our liability insurance policy for, let's say, a 3-year period. And let's say that insurance premium is, to make the math easy, let's say that it's $3,600. So we have an insurance premium of $3,600, and that premium will cover us for 3 years or 36 months. So if we divide the total premium by the total period of coverage, $3,600 divided by 36 months, our cost of insurance, in this case liability insurance, our cost of insurance per month is $100. So when we pay for that insurance premium up front, we would add it or debit an asset account called prepaid insurance. Keeping in mind, the definition of an asset is something of value that we own that will provide us with some future benefit. And that benefit, again, for every asset that we acquire, should somehow be tied to revenue generation. So in this case, as part of our operating requirements, we need to be insured properly. And so this asset, prepaid insurance, is providing that benefit to our business, that of covering us for liability insurance. And so when we pay for that insurance premium, we would debit or add to prepaid insurance the amount of $3,600. And our credit, again, just as in the first example, if we paid in cash, we would credit cash. Or if we paid on account, then it would be a credit to accounts payable. But we would debit or add to the asset account prepaid insurance. And let's say that's at the beginning of our calendar year, January 1st or 2nd. Now, what do we need to show for the end of the first month of operation, and actually for every month thereafter for the next 36 months? Well, we need to show for each month as that time period passes that we have incurred insurance cost or insurance expense for that month. And in this case, for this insurance policy, that cost is $100 a month. And so to adjust for that, we would need an account, an expense account called insurance expense. And just as we did for supplies, we would need to show $100 off prepaid insurance used up as a deduction, a credit to the prepaid insurance account with a corresponding debit to insurance expense. And so this would be our adjustment for prepaid insurance expired or used up each month for 36 months. We would have a debit to insurance expense and a credit to prepaid insurance. Our third example is again similar to the first two, but a little bit different. In this example, we're looking at depreciation. Anytime we have a long-term asset that we're going to be using in our business over a period of usually several years, we need to show that that asset is being used up over time, and we generally call that expense depreciation expense. Now that's a little bit of an oversimplification, and we'll come back to depreciation in a later chapter. But for now, let's keep it a little simpler, and let's leave it at that. So, let's say we're in the delivery business, and so we have purchased a delivery van, and let's say that van has cost us $30,000. So we would add delivery van $30,000 to we would add $30,000 to the delivery van account. And typically for purchase of this amount, our credit would be to a liability account, probably something like notes payable, because we would probably take out a loan to buy this type of asset. Now, we need to calculate the amount of our depreciation, and the calculation is done this way. We start out with the cost of the asset that we need to depreciate, and then we subtract an amount called estimated salvage value, an amount that we expect this asset to be worth at the end of its useful life. And that's an estimate. And so again, keeping it simple, let's say we expect this asset to be worth $5,000 at the end of its useful life. And so we deduct that amount from the cost, leaving $25,000 of cost to depreciate, and then we divide that amount by the estimate of useful life, our estimated useful life, how long we expect this asset to provide economic benefit to the company, to help generate revenue for the company. And so let's say, again, keeping it simple, let's say we expect this asset to last 5 years, and so we would divide the depreciable cost of $25,000 by 5 years of life. And so our estimate of depreciation is $5,000 per year. Now we need to show depreciation for 1 month, and so we would take this annual depreciation amount of $5,000 and divide it by 12 months in a year, and our monthly depreciation amount would be $417 rounded. So $5,000 divided by 12 is $417 per month. Our adjusting entry for depreciation, we would show depreciation expense under expense, and that amount would be $417. Keeping in mind, again, this is for 1 month. And for this type of adjustment, for this type of asset, this is where it's a little bit different from the first two examples. Instead of directly crediting the asset account delivery van, we need a second account called accumulated depreciation on delivery van. This is a contra asset account. It's an asset account, but it carries a balance that is the opposite of the typical asset account. So our balance in the contra asset account is a credit balance over on the right side of the account. And so our adjusting entry would be to debit depreciation expense for $417 and credit accumulated depreciation $417. And again, our depreciation calculation, cost minus estimated salvage value, gives us depreciable cost. And then we divide that amount by the estimate of useful life to give us depreciation for 1 year. And then we divide the annual depreciation by 12 months to give us depreciation for 1 month. Finally, anytime we look at this asset, the delivery van, or any asset similar to it, we need to always include its accumulated depreciation account. The difference between the cost of any asset and its accumulated depreciation at any point in time is referred to as the book value of that account. In the interest of time, I need to stop this lesson video. I hope this has been helpful. We'll come back to the next section shortly.